Wednesday, September 16th, 2020, Maneco 64, home of alternative economics and contrarian views. I get a lot of questions about the repo market, derivatives, the primary dealers. So we're going to look into that today. Derivatives, the repo market, and primary dealers. What it all means. Before I start, I've been talking about these subjects for years, ever since I started my channel in late 2015. I highly recommend a couple of videos I made in 2019 when the repo market troubles kicked off. Repo rate spike pointing to funding problems on Wall Street, September 17th, 2019. The other one is it's Repogeddon as the Fed hands out another $55 billion to Wall Street, right? And that was in October of last year. As for derivatives, I worked in the derivatives market in London for over 20 years. I made a video on July 19th, 2016 entitled Why Derivatives Are So Dangerous to the Financial System. So I highly recommend you watch those videos if you haven't yet. I'm going to put them up in the cards and below in the description. So let's start with derivatives. Derivatives were a great idea back in the 19th century when they were created, mainly to hedge agricultural exposure, agricultural prices for farmers. That's what it was used for. And that's why the Chicago Board of Trade, Chicago Mercantile Exchange became so important, because of Chicago's location in the Midwest, near the plains, all the transport hub, right? That was a great mechanism and still is, of course, for all those involved in the agricultural part of the economy against the vagaries of the weather, right, that affects prices. So that's where derivatives started, and I'm not against those kinds of derivatives. So the derivatives that are really dangerous are those that have been mushrooming and really growing ever since Nixon closed the gold window in 1971. Prior to that, there were no derivatives or futures on foreign currencies like we have today. There were no derivatives or futures or swaps on interest rates, on stock market indices. And why do I think they evolved? Well, because in the fiat currency system, there's so much instability that the derivatives helps the powers that be in Wall Street keep wagging the dog, so to speak, the tail wagging the dog. And what's the danger of derivatives? Well, it's all to do with leverage. That's the first thing I found out when I first learned about derivatives. When I was still at university in Geneva, Switzerland, I realized that you could bet a lot more than you have in derivatives, be it in the futures market or options market. So if you buy one future of a treasury bond future, you're controlling 100,000 nominal of treasuries, and you only have to put, let's say, $5,000 down. So that's the great attraction of derivatives. Not only the derivatives traded on exchange, but also traded on over-the-counter markets. So the over-the-counter derivatives are dealt amongst banks, primary dealers. I recommend you watch The Big Short to learn more about that. So it's highly leveraged. The bankers say that the notional amounts that they bet, and the notional amount, of course, is the size of the contract times the amount of contracts that they do. And it can be up to the trillions, as many of you have heard. During the '08 crisis, it was calculated or estimated that there was over 1,000 trillion or over a quadrillion of derivatives. Of course, the bankers at the BIS changed the regulations for that. So now it looks like the derivatives notional amount is a lot less, but I would say it's still very near 1,000 trillion or a quadrillion. So when the bankers are asked, how can you bet so much? Isn't it risky? And they will tell you, oh, it doesn't matter because there's a long and a short, and it all nets out, right? But as we found out, when one of the counterparty fails, like Lehman did, there is havoc in the markets, and that's what happened in '08. That was all because of derivatives. And it was a lot of it on mortgage-backed securities, credit default swaps as well. That was a huge derivative that exploded. There's a daisy chain reaction when one of the counterparty fails, right? So now let's go into the repo market, because that goes hand in hand with derivatives. First of all, what does it mean, repo? Well, it means a repurchase agreement. Basically, it's like a pawn shop for Wall Street, a pawn market. So primary dealers who are the biggest banks, basically the biggest international banks on Wall Street, City of London, and the major European banking centers. They're also primary dealers for the New York Fed. These people and some other financial institutions that aren't banks, they basically lend cash to each other, and they use U.S. Treasuries as collateral. So let's say Deutsche Bank has $1 billion of 10-year notes, and they need $1 billion of cash for one day to keep financing their operations. They will go to JP Morgan and say, JP Morgan, I want to lend you my treasuries. Can you lend me $1 billion for a day? So JP Morgan would say, fine, Deutsche Bank, there you go. There is your $1 billion. And JP Morgan will say, Deutsche Bank, make sure you give me back the $1 billion plus the interest, right? And then Deutsche Bank will repurchase those treasuries they lent to JP Morgan at a slightly higher price. So that's how it works. So why would Deutsche Bank need $1 billion? Well, because a lot of these primary dealers, they are also prime brokers to a lot of the hedge funds. And what do hedge funds do? They don't really hedge. What hedge funds do is that they will borrow $1 billion from Deutsche Bank, their primary broker, right? And then they will buy derivatives and leverage that even more, right? And that's how it works. And a lot of the hedge funds on Wall Street, guess where they originated from? Well, from the banks. They're mostly traders that used to work for the big primary dealer banks who did very well and decided to go on their own, right? So they could reap in a lot more of the profits that the banks used to reap in. So they set up their hedge funds offshore, of course. They get the financing. Guess from who? From their old employer. So they're all interrelated. So what happened in 2019 in September, as you see from my videos, and I'm gonna be very brief here, basically the repo market, the rate for overnight loans skyrocketed from around 2% to 10%. So the Fed had to intervene. Because there was trouble, the primary dealers didn't trust each other anymore, or the banks, right? Because they're mostly banks, as you can see from the New York Fed's list. And that's why the Fed had to intervene. And many in the alternative, like me and others, were predicting a lot of trouble for the markets, but the Fed intervened. And I would say that what we've seen this year has been a culmination of that crisis. Of course, there's nothing said much on the mainstream about the repo crisis anymore, but that's what really triggered all the Fed intervention last year. It also, don't forget, triggered the Fed to reverse its monetary policy. The Fed was supposed to be unwinding its balance sheet. The Fed was supposed to be raising interest rates. And look what they've done now. You know, they've cut rates down to almost zero. They've ballooned their balance sheet from around $3.5 trillion just before the repo market crisis started to 7 trillion now. So they've doubled it after that crisis. So that's why derivatives are so important to the system, and they brought the system down. The Fed had to just bail everyone out now, and it's going to get worse, in my opinion. So what the Fed has done and all the other major central banks, they've just kept this derivatives game casino going. And of course, Wall Street, City of London, major European banks, they're the major players in this derivatives market. That's how they manage to rake in their billions a year in bonuses. I mean, Jim Rickards has talked about banning financial derivatives, and I agree with him. Eventually, if we go back to a sound money system, I think we will go back to a time when only agricultural derivatives will still be around. We won't need all the other derivatives that we have today. So with that, let's quickly look at where the markets are this morning. It's just before 9 a.m. London. We've got spot gold at 1964.50. That's up 11. The high's been 1966 and the low 1950. Yeah, yesterday it looked like gold and silver were breaking out. They came back down. Of course, today we got the FOMC announcement press conference. That will be quite important. We've got silver at 27.31, up about 20 cents or 2/3%. Dow futures is up 84 or 1/3% at 28,078. S&P 500 up 12 or 1/3% at 34.12. A NASDAQ 100 future up 63 or 0.5% higher. Sterling is unchanged, 128.96. The euro is up 1/8% at 118.60. And the dollar is down 0.2% versus the yen at 105.24. The dollar yuan continues to trade lower. We're at 6.76, down 1/3%. Crude oil is very strong this morning. WTI is up 2%. And to finish off, 10-year yield is unchanged from yesterday, still at 0.674, the 10-year yield. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.